Hey there, welcome to Takeaway with Sam Oches, a podcast from Nation's Restaurant News. I am Sam Oches, editor-in-chief here at NRN, and this is the show where I give you an all-access pass to the restaurant industry's most influential decision makers. This week, I am talking with Uday Ahuja. He is the Chief Investment Officer for RSE Ventures. This investment fund was started by Miami Dolphins owner Steve Ross, and it invests his capital into emerging brands across several different industries, typically writing growth equity checks between $5 and $25 million. That includes several food and beverage brands, and to date, RSE has invested in restaurant companies like And Pizza, Bluestone Lane, Momofuku, and Milkbar. Uday is responsible for evaluating and executing RSE's investments, as well as for the ongoing management of those partnerships. And he joined the podcast to talk about the state of financing for restaurants in particular, and what emerging brand leaders can be doing right now to find capital to fuel their growth plans. In this conversation, you will learn more about why strong unit economics and profitability are key to securing capital for growth, why RSE encourages founders to meet with an industrial psychologist before finalizing a deal, and what brand founders who intend to scale should be doing right now to ensure future investments. Jumping now into my interview with Uday Ahuja, Chief Investment Officer for RSE Ventures. Also, don't forget to stick around after this interview as I will share my 6 takeaways from this discussion, actionable insights that you can take with you on the go. Have you heard about the California Food Service Instant Rebate Program? You can save up to $3,000 instantly on energy-efficient food service equipment when you purchase from participating dealers. Find out more at www.caenergywise.com/instant-rebates and find a participating dealer near you. Skip the paperwork and save instantly on your food service equipment. That's www.caenergywise.com/instant-rebates. Okay, Uday Ahuja, the Chief Investment Officer for RSE Ventures. Uday, thanks so much for joining me today. Uday, I guess let's just get started by talking about RSE. What is this organization and what is your role as Chief Investment Officer?
Sam, thanks so much for having me. RSE Ventures is a private investment firm that was started about 10 years ago as a partnership between Steve Ross and Matt Higgins. We invest Steve Ross's capital in direct private investments, and we're really born out of Steve's ownership in the Miami Dolphins and his desire to incubate, invest, and build businesses in and around the Dolphins, which led him to partner with our CEO, Matt. And our mandate has grown over the years beyond just sort of our sports and entertainment roots. We invest in companies in the media and marketing realm, consumer, which includes food and beverage, restaurant, CPG, and consumer tech more broadly. As the Chief Investment Officer, I am responsible for evaluating new investment opportunities, execution of these transactions, sourcing these deals, and then perhaps most importantly, managing RSE's involvement in each of these transactions following our investment. Our MO is typically writing growth equity checks of $5 to $25 million in companies that are not fully established but are in that growth phase. So in, let's say, restaurant parlance, someone who has opened maybe 10 units, 15 units, has proven out they can make their business model work with great repeatability, maybe in different markets. That's where we enter in and provide capital for further growth. And in return for that, we take significant minority stakes. We also have a bucket of capital where we invest 250 to 500K checks in early stage companies. And that's just ongoing activity. We feel like it is important for us to meet founders early, get involved early in some instances, and that helps us the opportunity to get to know companies from the very outset. So because we have a single LP structure in managing Steve's capital, we have the flexibility to go in a lot of different directions, which perhaps maybe some of the other consumer funds that you maybe talk to on a regular basis don't have. So in some respects, we're like a family office.
Yeah, you mentioned the founder piece of this, and you guys have some pretty significant founders in your portfolio. I know Christina Tosi has been a part of it, but you also have people like David Chang. You are invested in Fuku, Bluestone Lane, and Pizza, and Michael Astoria, and so clearly there's something to your strategy that's beyond just the potential of the brand. It seems like
Right.
it really is. There is something about cheering for these people who are so committed to the brand that they're building, which are all those people I mentioned. Tell me about that strategy a little bit more and why that is such an important part of it.
Absolutely. It all starts with the founders and, being founder led. That's important to us as we look for investment opportunities, and the fact that there's a passionate following for these founders and the businesses they're building. Beyond that, as you've asked, there's the traction beyond the first few units, proof of concept, and sort of a repeatability of financial performance. And then we also go seek validation from the rest of our portfolio. So if we're looking at a new investment opportunity, let's say in restaurant tech, right, we will go talk to our various different, food and beverage concepts and say, hey, do you think this could be applicable in your fleet of locations? And we get feedback that way. But perhaps now more recently of more even increasing importance is the ability to scale. Does this concept or this company or this brand have the ability to scale? And so let's say it's and pizza, for example, right? Can we get to 100, 125 units? Will this model work repeatably and consistently? But in other cases like Milkbar, it doesn't have to be 100 and 125 units, but can we gain scale by having an omni-channel business? Can we sell direct to consumer? Can we go to grocery stores and sell retail via CPG products? So there's multiple different ways to achieve scale, and growing store count is just one of them. There's also the omni-channel nature of it, which is something that is of increasing importance beyond the initial founder-led business with a passionate following.
Sure. Well, as you mentioned, circling back around to this concept of kind of a diversified portfolio, why is that a beneficial approach to your investments, to have it kind of spread across multiple buckets? And how is your restaurant portfolio in particular supporting kind of the rest of the RSE approach to things?
Yeah, I think it's a great question. I think there is the ability to sort of focus and scale, and then maybe eventually take learnings and apply them to future investments. But for now, we feel like we have hit some of the major categories, fried chicken, pizza, coffee with sort of the health food in the cafe, and sweet indulgences with Milkbar and Magnolia more recently. And so we feel like we've covered the big categories. I guess if you sort of look at our portfolio, the big categories that are missing are probably Mexican, is one category. We're always looking at stuff in that category, and haven't really pulled the trigger on anything yet. But we feel like that diversified approach is best for us, rather than sort of go down one vertical and stick to it.
Mm. Okay, so here we are, 2023. You and I last spoke in 2020, and right as things were kind of most crazy in the COVID pandemic. 3 years on, how do you think the strategy around investing in emerging restaurant companies has changed? Has it changed your approach to what kind of companies you're looking for?
Yeah, I think it touches a little bit on what we talked about before, which is the ability to scale. And I think that became much more apparent as the COVID pandemic progressed. And just to take an example, Milkbar is a great one, where initially, even though the pandemic impacted the stores and the closure of retail, as we sort of felt across the industry, but Milkbar was able to gain great traction through its direct-to-consumer channel and through its grocery channel, which it launched in April 2020, so tough time to launch. But
Right.
That allowed the business to expand and thrive and play offense a little bit rather than just continue to play defense, which a lot of the industry was doing. So in in reflecting on that experience, we believe that it is increasingly important to have scalable businesses. One of the ways to do that is to have omni-channel presence, but also, there's a variety of different ways to do that, right? Again, we talk about being able to build lots of stores, but going to CPG is also one other aspect, right? Like, what better way to gain ubiquity across the country by rather than selling in sort of grocery stores? So, that's another important element that we look at in sort of the transition from 2020 to 2023. Not that we weren't, but I think it's become even more important. And then the most important shift recently is obviously with the profitability of these businesses. I think up until, call it a year ago or 6 months ago, there was a growth at all cost mentality across the entire spectrum. It wasn't only consumer businesses, it wasn't only restaurants, it wasn't only F&B, right? It was across fintech, you name it, every industry, because capital was so readily available. But now, given that capital has dried up for a lot of businesses across the board, there is an intense focus on profitability and unit economics. And if you can't show that you have a sustainable business and grow scalably, but with solid sort of fundamentals and foundations, then I think that you're going to have a really, really hard time getting funded. So it's profitability is important. Solid unit economics are important, more so than they've ever been before.
Yeah, that makes a lot of sense. Yeah, I've spoken to a few people in the past couple of months that are involved in not necessarily investments, but are involved in, leading portfolios, making acquisitions, things like this. And I've asked all of them this, and I feel like I've been circling around it, but I'm just curious from your perspective, what about the economy right now, the macroeconomic conditions of right now makes investments or acquisitions attractive? Because it feels like there's been a lot of activity in M&A. There's been a lot of activity in brand securing investments. Why now? Why does this economy merit that kind of activity?
Well, I think right now people are sitting on the sidelines. So I think we are seeing some activity happen, but I think there's going to be a lot more in the next, call it 6 to 12 months, as there is more clarity on the environment. Right now, there's a lot of conflicting data, right? Inflation is headed in the wrong direction. It's sticky and it's here to stay a while. Household saving rates are strong, but key pandemic policies are now rolling off. So everyone is wondering how that's going to impact. Unemployment has stayed fairly strong. So I think there's a lot of conflicting signals, and I think everyone is just waiting on the sidelines for clarity on and the shoe to drop, if you will. So the uncertain environment actually causes more challenges. And I think when we have that clarity, that's when we'll start to see more capital flow and more deals flow, because investors who are right now sitting on the sidelines will be able to underwrite their business plans for their various investments with more confidence. They'll be able to sort of say, okay, these 3 to 5 sectors got impacted because we're now in a recession or the following things happened. And so we kind of can look at these businesses and say, okay, this is what's going to happen for the next 12 to 24 months. Our capital that we're going to put in is going to see these businesses through this turbulent, uncertain time. Nobody wants to put in a check only to come back and say, okay, in 12 months, we need more capital. So as long as there's clarity, the money will probably start flowing more so than you're seeing now. That said, if you are an investor who is looking to deploy capital right now, there's a lot of opportunity, because there are a lot of companies who need that capital and are just surviving. But to thrive, they sort of need to do more than just that. So
Sure.
There are lots of opportunities, but I expect it to open up way more in, call it, the next 6 to 12 months.
Okay, so tell me about sort of the diligence part of all this for RSE, in terms of you're intrigued by a brand. What's the work you're going to do? Because you explained some of those things you're looking for. You're looking for operators who have their act together. They know what they're doing. They've got strong unit economics. Walk me through the process of identifying target brands or just categories to a point at which RSE decides, yeah, we're gonna place our bet with you. We think you're the real deal here.
Yeah, absolutely. I think it's a great question. And so I think it starts with the founder, right? And the presence of the brand and sort of the following of the brand. And that's where we start. And there's obviously ways to measure it, but it's something that you can see, feel, and experience for yourself. And once you've sort of done that initial diligence around the founder and their sort of founding team and the management team, you start digging into the numbers, right? To that repeatability point that I mentioned. How have they performed? The first location was amazing, but did they do the same thing in the second and the third and the fourth? Was this received in the same way in Washington, D.C. in terms of performance as it was in New York? And so you try to isolate a lot of things through financial diligence, but an inordinate amount of our time is spent on understanding the founders and their teams, how they came together. We have oftentimes our founders meet an industrial psychologist that we work with to really understand, are they able to sort of grow and evolve with the changing environment that they're going to be functioning in, because it's almost guaranteed as we have looked at various investments and participate in a lot of investments, the team that starts the business is very different than the team that's in 5 years into the business. At every stage, there's an evolution. And the founders who can best marry that cultural fit of bringing in outside subject matters experts, integrating them with their culture of their teams that exist with this sort of core founding teams, are the ones who are probably going to be most successful beyond having a proven scalable concept. So we spend lots of times figuring those things out. We look at obviously comps that have done similar things. We look at how the broader macro market is performing. So if it's a coffee-led brand, how have coffee multiples trended over time? So those are basic things we do, but an inordinate amount of our time is spent on founder and management team.
Got it. Obviously, this differs across investors, but I'm curious from the RSE perspective, how much, I guess, call it handholding do you do? Once you've made an investment, how much do you want to be active in the decisions that the founder and the brand is making? What is that partnership, I guess you could say, looks like?
Absolutely. Great question. We, by sort of definition, are large minority partners. So we have a seat at the table, and that comes with having a certain role at the board level. We don't want to be in the business of running the business on a day-to-day basis. That's not good for the founder. It's not our model. If we find ourselves in that position, unless we own the whole business outright, we're doing something wrong. So our main role is to be a sounding board and a good partner for the founder. Talk to them about strategy, compare notes, connect the dots across our portfolio. Hey, we're seeing this in End Pizza, Bluestone Lane. Maybe you should think about the same thing, or vice versa, whatever. Expanding in DC in these neighborhoods. So there's a fair amount of information sharing from that perspective that can take place. But primarily, it's about being a sounding board for the founder, evaluating sort of strategy, helping formulate compensation plans for the management team, designing equity plans for employees that are going to be part of the business, vetting budget numbers, understanding cash flow, helping sort of raise new funds. So it really spans the spectrum. And in our world, we think, and obviously, hopefully our founders will validate this, that we're good partners to be able to do all those things and sort of walk hand in hand with these founders and help them manage that evolution that they are facing, which is, of course, as we talked about, very different when they're a 15-unit shop versus a 50-unit shop, right? Recruiting board members. As you evolve, you want a best-in-class board to be able to advise you that is appropriate for the stage that you're at. So it spans the spectrum. It's a tough question to answer because there's just so many things that we're involved in, but those are some of the more important, noteworthy things that come to mind.
Absolutely. For those entrepreneurs who are listening right now who might have, founded their own restaurant concept, certainly anybody who's in the process of scaling their restaurant concept, what's your advice to them? Because I know a lot of them, it's obviously they've got a lot of things to worry about, and finding the capital to scale their business While it's probably a priority, it's a lot harder of a thing to think about, to focus on, even to know where to begin. And so for those out there who are looking for capital, what is your advice for the steps they should take to put themselves in front of the Udays of the world or other investors? And what can they do to make sure they're in the strongest position they possibly can be when they are talking to you?
Absolutely. So in general terms, sort of the specific environment aside, there's no substitute for networking. And, reaching out to as many investors as you possibly can, even if you're not looking to raise capital, to understand what they are looking for. And so that you can at least have that orientation at the back of your mind as you're looking to build your business. Now, that may not be best for your business, so it's up to you as an entrepreneur, as an owner of the business, to decide what path you want to take it. But there is no substitute for talking to as many people in the industry as you can, especially people who have been there and done that before, whether that's investors or other entrepreneurs who've scaled multi-unit retail before, and really understand what are the key levers along the way that people look for as validation that your concept is working, your strategy is working, your restaurant economics are solid. And then to this moment, more specifically, it's really about building a profitable business more so than showing that, hey, I have this pipeline that I'm going to develop that is 15 units long in the next 2 years. I think people and investors want to see strong fundamentals and disciplined growth more so than that growth at all cost mentality. So it's really rooted in the fundamentals of your business. And then secondarily, at least from our vantage point, once you have that figured out, can this scale successfully? Can you do this in a more disciplined way? So even if it means not opening 15 units over the next 12 months, but maybe 15 units over the next 3 years, so that you are a self-sustaining business and can generate cash and then grow from there, I think that opens up a lot more doors than just saying, hey, I have this massive pipeline that I need to fund. So it's about understanding the key drivers that make your business tick, really understanding your category, and then how are you going to grow this into a big business from there.
Your CEO, Matt Higgins, you mentioned, he's been a guest judge on Shark Tank before. He's made a name for himself, certainly. Shark Tank is so fascinating. It teaches, some of the dummies like me, a little bit more about the art of the deal or how to negotiate some of these things. And it's fascinating because, obviously the sharks on that show, they know what they're doing. They're very good at crafting a deal. And I think a lot of the entrepreneurs come on and they're looking for the most amount of money to give up the least amount of their business for the most amount of money, I guess you could put it. But there's a lot of give and take here when you're making a deal. What's your advice for founders as they do approach these relationships? How do you get favorable terms? It's going to be different for everybody. You can't speak for other investors, and I get that. But what is it that you can, offer to these entrepreneurs in terms of how to, show them that the deal they're getting is favorable, even if it isn't the amount of money they were looking for, and even if it is more of the business that they were looking to give up?
Yeah, it's a great question. I think you've got to put yourself also in the investor shoes, just as the investors got to put themselves in the founder or entrepreneur shoes, right? So maybe for an investor in this environment, downside protection is more important. So meaning that, without getting into too many details here, but structuring an investment that provides a certainty of returns is more important than valuation. And so an entrepreneur should be able to acknowledge that, and the founder should be able to acknowledge that and say, okay, then in return, maybe I should get a better valuation than I would have otherwise gotten. So there's always push-pull here. But it takes me back to an example. We were dealing with an entrepreneur many, many years ago, and he was very, very insistent on having control and nobody involved in sort of the day-to-day functioning of the business. And despite assurances, he's very fixated on that. And there's multiple parties at the table here. And to him, that meant having 51% ownership. And when you sort of triangulate the math other parties coming in, valuation, how much money is coming in, that 51% just didn't make any sense. So it was a long journey in trying to convince him that control isn't only met through economics, but there's also lots of legal terms and different protections and mechanisms that you can have in an agreement that protect you from the scenarios that you're envisioning are the worst case scenarios, right? Nobody wants to take you away from the job. You are the heartbeat of the business, and this business will succeed and fail because of your efforts. So nobody wants to take that away from you. So instead of maybe looking at this from an economic perspective where you have 51%, maybe you need to look at it and say, these are the things that are important to me. You cannot remove me. You cannot do X, Y, and Z. And unless the following things happen, right? And so there's multiple ways that you can approach that conversation. So again, as as a founder, entrepreneur who's seeking capital, there's lots of give and take, lots of push pull, whether that's on the economic side, trading, valuation for protections, or on the legal side with the operating and governance of the company on an ongoing basis.
That's a great answer. That makes a lot of sense. All right, I want to pivot a little bit. You guys also invest in restaurant technology, not just restaurant brands. Why is that? What is the potential you see in restaurant technology firms, and how is that comparing to what you see in restaurant brands themselves?
Yeah, I think it's the whole ecosystem, right? I think we never started off as being a CPG shop or a tech shop or a restaurant shop. We sort of grew organically because it made sense for us, and we were able to use our portfolio to validate those opportunities. So to the extent that there are opportunities in restaurant tech that we can validate from our existing portfolio, more or less, then that makes sense for us. So for example, we invested in this company called Rescue, and it sort of went more to that initial bucket on the early stage side, which puts in that 250K to 500K check. So it wasn't our typical growth equity investment, but it was a company we were interested in because a lot of our companies validated that it was a problem that needed to be solved. And lo and behold, they became adopters and are very happy with that service. This is sort of a repairs and maintenance platform where you can just with a click of a button say, my location, I need a plumber, or my HVAC system is broken, go to their marketplace and say, these are the approved contractors and they're going to be over in, call it, later today. And so that solved a real pain point for a lot of our concepts that otherwise maybe would have had to shut a location down for a day or two to get their whatever thing repaired. So where we can validate and make those extensions of our portfolio, it makes a lot of sense for us. And then in a certain sense, technology concepts are inherently very scalable, and maybe I've overused that word today in our conversation, but it is true. And Rescue and other such restaurant tech businesses have large applicability. And once they get adoption, it's off the races, right? Then it's about selling it in. So there's a scalability play that tech companies have that maybe others don't.
Yeah, you don't need the brick and mortar for the technology company. Although I'll tell you, there's a image going around. I saw it at a conference and it popped up in the email too. There's an image going around of logos of all of the tech vendors, all the vendors serving the restaurant technology space, and it's overwhelming. I mean, there's so many, and so
to see it, you have to really squint hard to see if you find the logos of the companies that you know.
Yeah. So I guess, from your perspective, and I know you had some technology experience in your background too, even prior to RSE. So I know you've got a good handle on this, better certainly than I do. Where does this go from here? Because if I'm, a restaurant founder that you work a lot with, and I've got so many things to think about, and having 25 different ordering platforms to choose from is not one that I wish to have. Tell me, is there consolidation coming for restaurant tech? What does the future of this industry look like?
Look, I think what you saw was a function of the environment over the last 5-7 years, right? There was a lot of capital readily available, and not to say there won't be capital available for great entrepreneurs and great ideas, but now increasingly for the already established or in existence companies, especially at the stage at which these companies operate, you need capital to keep going. And so invariably, because the capital will dry up, you will see a lot more consolidation, or unfortunately, in some cases, companies will just go away, which is very, very unfortunate. But having said that, if the technology is truly valuable, there will be a buyer for it. There will be someone who will consolidate it. So in that sense, I think it's a function of the time, but sometimes you need the consolidation to shake it out, to go against the problem that you mentioned. You don't need 25 platforms. You need the top 2 or 3 that are most effective, or in some cases we have seen now aggregator platforms that come in and sort of pull all those things together, which are also effective. So there's no easy answer to this except to say, as you mentioned, there should be consolidation in the industry, if nothing else, by function of, hey, we don't have the capital to grow, or B, restaurants themselves will look to cut down on spending, and so I'm not going to have the 20 people that I need. I'm only going to have the top 3 people because I just don't have the time or bandwidth or the manpower to deal with all of these different vendors.
You mentioned a restaurant category that you were looking at now that you're interested in. What's a tech category you're interested in? What are some restaurant tech platforms or specific services they provide? What is the future, I guess, of tech, and what interests you?
Yeah, look, I mean, we're pretty diversified. We're very open-minded as to different tech platforms. So I can't say we're looking at specific avenues, but there is a focus for becoming more efficient, improving labor productivity. So if there are tools that can help sort of improve back of house or predictive analytics on the modeling side, or anything that helps us with our CRM and customer acquisition strategy and driving traffic, I think those are all big bucket areas that we're happy to have inbounds on, or figure out via our various restaurant partners. And so to that end, if there are concepts in those various disciplines that want to reach out, please do so via LinkedIn. Always happy to receive an inbound and take it from there. But it's about efficiency on the back end and back of house, I should say, and then also on the customer analytics platforms. How do we become way more sophisticated about rewarding our customer base, and also attracting new people and giving them the experience of our various different concepts.
Amazing. We've been talking about tech for 5 minutes and have not mentioned AI at all. Are you looking at AI? I mean, it feels like that's all we're talking about when it comes to tech. Yeah.
Yeah, early days. Look, it's going to have wide applicability, but I can't say there's anything very, very specific that we are excited about at the moment, but if there is, I'll be sure to reach back out.
Good to know. All right, so Uday, going forward, RSE, what do you foresee for the coming years? Again, you mentioned some of the areas you're kind of interested in looking at. Any specifics about how you hope to invest your money at RSE? What are some directions you hope to take this organization?
Yeah, great question. And, I think right now it's a lot of wait and see for the entire industry at large. So there will be opportunities, and we're always happy to look at new opportunities, especially sort of as we progress in the second half of the year. As we mentioned, we are actively looking at more and more CPG brands than we have before. So that's an added area of focus now and into the future. We just completed a small investment into this company called Titbits, which is a better for you candy company that we are very, very excited about. And so there'll be a few more of those, I'm sure, down the pipeline, but CPG is an increasing area of focus for us going into the future.
Okay. All right, Uday, last question. There are a lot of options available to startup leaders in terms of financing. They can bootstrap it, they can franchise. Why is an equity group like RSE, why is that a strong way to access capital for growth?
Yeah, I can only speak to about ourselves, and I think our philosophy and ethos is one of a family office. We're long-term partners. And, Steve by nature and Matt are builders and developers, and have a long-term interest in owning businesses. And so there's less of a trading mentality on our end. So we we are happy to go along for the ride with our founder partners. And I think in that sense, the incentives are aligned. We've partnered up with a lot of founders who eventually at someday are going to want some monetization or some exit, and our time will come. I think there's a lot of different funds that are out there that will probably put in your agreements with founders or companies, in 5 years we're going to force the sale of a company. I think we're sort of more of the opinion that our incentives are aligned with founders, and when the exit event comes, they will come because the founders will know it's the right time for the business. So from that perspective, our orientation, I think, is differentiated, and hopefully our track record kind of speaks for itself in terms of partnering with founders and building these businesses for the long term, weathering these sort of storms of the last 3 years. So yeah, I guess the message to any founders and entrepreneurs who are listening are, do your diligence and your research on your potential partners, really sort of learn more about their philosophy, talk to their investment partners and who they've done business with, so you know exactly who you're getting into bed with.
That's great. Uday Ahuja, the Chief Investment Officer for RSE Ventures. Uday, thanks again. It's a pleasure as always.
Thanks for having me on, Sam.
Have you heard about the California Food Service Instant Rebate Program? You can save up to $3,000 instantly on energy-efficient food service equipment when you purchase from participating dealers. Find out more at www.caenergywise.com/instant-rebates and find a participating dealer near you. Skip the paperwork and save instantly on your food service equipment. That's www.caenergywise.com/instant-rebates. That was my interview with Uday Ahuja, the Chief Investment Officer for RSE Ventures. So what should you learn from this interview? Here are my 6 takeaways. My first takeaway is that founders are the heartbeat of an emerging restaurant brand. This is something that RSE thinks a lot about because they are specifically looking to partner with restaurant companies that have that strong founder. And their belief, with the founder being that heartbeat, they're the one that's passionate about this company, and so passionate that they're going to do what it takes to scale it and to see it to its full potential. A founder is often the face of the company. They're the ones driving the marketing, the messaging. Obviously, they're making all the decisions. And so that founder is critical to the success of the company. But of course, it's some of those intangibles. It's that passion, it's that excitement, it's that willingness to do what it takes that founders usually possess. And RSE wants to tap into that. And so that's why they specifically look for investments where a founder is present and key to that growth. I think that's an important piece of advice to remember for restaurant companies that are looking to scale. If your founder is still there and very active in the business, find ways to lean into that because that is very appealing to investors like RSE. My second takeaway is that there are multiple ways to achieve scale. Of course, the primary way people think about scale is to open new locations, especially in the restaurant industry. But an investment firm like RSE, when they think about scale and scaling one of their investments, they're not just looking to multiply the number of locations. They see scale as including omni-channel business opportunities, like direct-to-consumer service, possibly CPG. There's a lot of different ways to consider scale and to getting this brand in front of more people. And so while RSE is looking for that, I'm sure many other investment firms are similarly interested in scale, however you define it. And so it's something for a restaurant company to think about. You might be thinking about opening new locations, and that is important. But what are other ways you can scale your business, scale the exposure of your business, the reach of your business to new customers? That is another thing that is going to be appealing to investors. My third takeaway is that today, more than ever, strong unit economics and profitability are key to securing capital for growth. Before the pandemic and even at the beginning of the pandemic, growth at all costs was kind of the environment. There was capital everywhere. Uday spoke about this in our conversation that investors were throwing money at emerging brands and encouraging them to just step on the accelerator, go, go, go. You hear a lot of people talk about being fast to market and being the first to reach a certain scale, things like that. That's not the environment that we're in today. Of course, the economy is unstable, shaky at best. A lot of the capital has dried up. And as such, investors are much more carefully placing their investments, placing their bets on the restaurants that they're partnering with. What they are looking for is not how quickly can we scale this thing. What they're looking for is unit economics. How disciplined are you in your fundamentals? Do you have fundamentals down? How profitable are you? How smart are you within each individual restaurant? Is there efficiency that you're achieving? You have to clean up your restaurant operation and make sure those fundamentals are down. Make sure you are profitable before an investor is going to take a chance on you in this economic climate. But that leads me into my fourth takeaway, which is that the capital will start flowing when there's more certainty in the economy. Uday thinks that's maybe 6 to 12 months away. But right now, the economy is still very, very uncertain. Inflation is still going up. Of course, we've seen some banks. We saw the Silicon Valley Bank fail. We see other banks maybe being a little bit shaky right now. Yes, the labor situation is becoming better, but in general, the economy, we just don't know what's going to happen. And as Uday pointed out, typically when you don't know what's going to happen with the economy, you're not going to make any investments because you have no confidence in what could come of that investment. So right now, there's not a lot of capital out there. If you're looking for capital, it's not going to be too easy to come across right now. But Uday thinks 6 to 12 months from now, you're going to start seeing that capital flow again because we'll just have a better idea of where the economy is at that point. And investors will just have more confidence as they underwrite their investments. My fifth takeaway is that a team that starts a business is very different from the one that is going to be scaling it in the future. This is why that Uday said that they have founders meet with industrial psychologists. I thought that was really interesting. I've never heard that before. But the point that he's making is that there's a lot of change that comes about to a company as it scales, and that especially is in the people. Sometimes the founding team is not the right team to take it from 1 to 10 or 1 to 20. Sometimes you have to bring in people from outside the organization, and not every founder can deal with that. Not all of them can handle the kind of pressure that these investments bring and that scaling can bring. Not all of them can handle the kind of conversations you have to have with your team and the kind of decisions that you have to make along that journey. So RSE, as they make their investments, they want to make sure founders can handle it. But I did appreciate that Uday spoke about how the best possible founder is somebody who can both balance the existing talent or founding team as much as they can while also integrating outside members, smart people who can come in and be a good fit for that organization. It can be done, and that's what RSE is looking for in the founders that they partner with and that they make investments with. My sixth and final takeaway is that if you are planning to scale your business, you should be networking with as many investors as you possibly can. Even if you're not ready to take an investment right now, even if it's just something in the future, what Uday says is there is no substitute for networking. Get out there, meet investors, pick their brain, ask them to lunch, pick up the phone and call them, shoot them an email or a LinkedIn message. They want to get to know you too. It might seem intimidating, but this is what investors do. They meet with leaders of emerging restaurant companies, if that's the kind of investment they're looking to place, such as RSE. And they want to get to know you as much as you want to get to know them. So don't be afraid to take some chances. Network with investors. Ask them what they look for, what their expectations are, how you could possibly get an investment from them, even if it's not likely. Just what would it take? In doing that homework, by the time you are ready to seek an investment, you're going to have all of those connections already made. You'll have a lot of that knowledge already behind you to help you understand what it takes to get out there and secure capital for growth. Those are all my takeaways for today. I hope you enjoyed this episode. Please remember to subscribe to Takeaway wherever you listen to podcasts and leave your feedback. You can also email me at sam.oches@informa.com. Thanks again, and talk to you next week.